Good afternoon, everybody. My name is Scott Rutter. I'm the founder of the New Jersey Canna Business Association. Thank you all for joining today. We have a fantastic person who's going to speak about 280E. But before I introduce Sandy, I want to thank our sponsors for all of our lunch and learns. So we have Sprague Energy, who is our preferred energy partner. We have Financial Resources Federal Credit Union. We have Curaleaf. We have our partners over at Burton Trent Public Affairs, HPK, Township Green, Proteus 420, Sachs LLP, Dutchy, Huffin, Canna Renobees, and DM Labs LLC. So I want to thank our sponsors for making this event possible. And I'm super excited in a very timely way. We're going to be talking to Sandy Suchoff from Cannabis CPAs, and she's going to be discussing 280E and all the complexities that's going on. And she also has some timely news to share as well. So I'd like to turn over to our good friend, Sandy.
Hi, everyone. Welcome. Thank you for being here. I'm going to share my screen. And as we go along, if anyone has questions, just put it into the chat. And Scott later on will address as much as we have time for. So please get all your questions in there. I'm happy to answer them.
Excellent. Let's go.
Okay, here we go. All right, so again, I'm Sandy Suchoff, CPA. I'm the founder and principal of the Canna CPAs. We're a CPA firm that has been catering to the cannabis industry for over 7 years nationwide. We have clients from Maine to Alaska, and we're just so stoked that it's here in New Jersey, in our hometown, home state. I've been featured on MSNBC, Fox, Chasing News, PBS, Channel 13, Marijuana Venture, the National Marijuana News, Snoop Dogg's Mary Jane, CPA Trendline. Been nominated for the California Cannabis CPAs, voted number 9 accountant in the state of New Jersey, and top 50 most influential accountants by NJCBA. I speak nationwide on cannabis tax and accounting, case law, how to run a profitable cannabis business. I co-authored a book on cannabis tax strategies, and any month now we'll have my latest book coming out on how to run a profitable cannabis business. So today we're going to look at the background of cannabis tax law, how it came to be, Internal Revenue Code 280E, cost of goods sold and its significance with respect to 280E, the different cannabis verticals and how the punitive tax law 280E affects these verticals. We'll even show demonstratively some profit and loss statements, one that will be for a dispensary and one that will be for a grower or processor. We'll learn what inventoriable product costs are and the need for inventories, direct and indirect costs, why GAAP accounting helps strategically save you taxes. We'll differentiate between non-inventoriable and non-deductible cannabis costs versus deductible cannabis costs. Entity structures, what's the best structure for your cannabis business? A lot of you are new starting out here. The importance of proper record keeping. And then we'll talk about what not to do, and we'll learn about Internal Revenue Code 482 and management companies. We'll also go into retail tax strategies for dispensaries and transportation delivery and even distributors, Form 8300, and then we'll summarize these strategies. So background of 280E. Now first, let's preface it that it doesn't matter if your business is legal or illegal. You are responsible for filing your tax returns and paying taxes. And back in 1974, there was a landmark tax court case, Edmondson versus Commissioner. Edmondson was in the business of selling amphetamines, cocaine, and marijuana. And a lot of individuals, when they are arrested or busted for drugs, what the local government or federal government does is they assess them the market value of their drugs and their cash that they confiscate, and they put it as revenue. So it's like an examination report. They have to pay taxes on this income. And for Edmondson, he was allowed to reconstruct his records, and he deducted things like rent, packaging, utilities, a scale, travel, telephone, and automobile, etc. And everything except a few travel expenses that he could not substantiate was allowed. And this clearly did not sit well with the federal government. So this was the catalyst to enact Internal Revenue Code 280E. Now, 280E is a part of our tax law that says there's no deduction and no credit for any business trafficking controlled substances for Schedule 1 or 2 of the Controlled Substance Act, and it's federally illegal or illegal in the state in which they're doing business. And cannabis, aka marijuana, is on Schedule 1, which is crazy. Now, I'm going to interrupt this because we have some breaking news here. The governor of New Jersey, Phil Murphy, has signed a bill into law that will allow licensed marijuana businesses to deduct these 280E expenses on their state return. So it'll be an adjustment on their state tax return. So it's a partial remedy because you're still liable for this on your federal return. You still have this effective punitive tax on your federal return, but with respect to the state, you will no longer have it here in New Jersey. And if anyone's interested in finding about other states that allow this add back of 280E expenses, I just recently blogged about this. If you go to the CannaCPAs.com website and go on blog, you will find the other states. But today, I thought it was very timely to share that Murphy enacted this. But it does say that the legislation he signed shall apply to taxable years beginning on or after January 1st following enactment, which is indicative that it will be 2024. I think originally, if I understood correctly, they were targeting 2023, but it's going to be effective 2024. So if I am interpreting it correctly, that would mean 2023. If you are active in your cannabis business, you will not be allowed to deduct those expenses disallowed federally, but commencing in 2024. But also a shout out to the NJCBA because they were an integral part to craft this legislation and work with Murphy and other people to enact it, and they advocated it. And we owe great thanks to the NJCBA to helping us, everybody in the cannabis business here in New Jersey, because this will save. New Jersey's tax rates are pretty high. So in the long run, that will be a significant savings for your business.
Thanks, Andy.
Okay. So the Controlled Substance Act, because we talked about on Schedule 1 or 2 of the Controlled Substance Act, is defined as to manufacture, distribute, dispense, or possess with intent to manufacture, distribute, or dispense a controlled substance. So for example, a testing facility. A testing facility is not distributing or dispensing or manufacturing, nor do they intend to. They are providing a service. So we can deduce that in this case, a testing facility would not be subject to the Controlled Substance Act and therefore would not be trafficking. All right, cost of goods sold. Now, the tax court, after enactment of 280E, came back and said that with respect to 280E, cost of goods sold is not deemed to be a deduction, but rather it's seen as an adjustment at arriving at gross income. And if you ever look at like a Form 1120, a C corporation tax return, it'll have gross receipts less cost of goods sold equals total income. It'll have other things in there like interest and dividend revenue, but essentially that's the formula. So it's consistent with that. And cost of goods sold, simply put, is beginning inventory plus the purchases you made during that entire accounting period minus your ending inventory. So the taxpayer capitalizes their inventoriable costs. And what are inventoriable costs? Those are the costs necessary to get your product into inventory and ready for sale when they're incurred, and then they remove it via ending inventory on your profit and loss statement under cost of goods sold. Okay? And I have another definition here for inventoriable costs, but all the same. So what does that mean? That the more legitimate deductions that you have for cost of goods sold, the lower your taxable income and the lower your taxes. Remember, there's no other expenses or deductions other than cost of goods sold. So clearly, any method of accounting that can maximize your cost of goods sold deductions or strategies is essential because that's the only way you're going to save money. So let's look and evaluate some verticals and how the 280E impacts these verticals. So we have cultivations or growers or farmers, or actually in New Mexico, they call it producers. They grow, they are essentially the farmers, they grow the cannabis plant. Now, one might think that the agricultural tax code would pertain to cultivators, but no, that's not true, because agricultural businesses are allowed preferential deductions and credits. So like processors or manufacturers, they are both subject to the manufacturing tax code that we're going to learn about shortly. Now, by virtue of what a grower or a processor does, they inevitably have more inventoriable deductions than, let's say, a retail dispensary, or a retail delivery transportation, or even a wholesaler distributor. A cultivator and a manufacturer is creating a product and will naturally have more inventoriable costs. In contrast, a retail is more severely limited by 280E. What they're doing is designed to sell. That doesn't mean we don't have tax strategies, and we will learn those tax strategies for both sets of verticals, but just pointing out that a dispensary will have a higher effective tax rate than a grower or manufacturer. So this is a fictitious profit and loss statement, clearly, but it's just designed for demonstrative purposes. This is saying that it's a C corporation. So a C corporation at the federal level is a 21% tax rate. And for cannabis businesses, tax is assessed at the gross profit level, revenue less cost of goods sold, not at the net profit. So in this case, we have cannabis sales of $1.05 million. This is, by the way, dispensary. We have beginning inventory and purchases. We have some indirect costs we'll talk about later, indirect labor, that might be inventory labor, etc. Less ending inventory equals your cost of goods sold, and that is your gross profit. So the gross profit here is $725,000. A C Corp tax rate is $152,250. Now let's compare that if it was any other business where you can deduct salaries of 100, rent of 30, utilities of 20, advertising of 50, admin of 65, with a total G&A, general and administrative expenses of 265. That net income is 460, and a business that is not trafficking a controlled substance would pay taxes federally at 96,600 compared to 152,250. Now, this doesn't mean that you're paying X amount of percent more. This is just to show you the difference, that a dispensary will pay significantly more taxes than a non-cannabis business. However, it will even pay more than a grower and a processor. So here is a sample grower processor. And while cultivation and manufacturing still pay an effective higher tax rate, a dispensary will likely pay even a higher tax rate because there's less inventoriable cost of goods sold cost to include, because you're getting taxed at gross profit. So in this example, you had the same cannabis sales, but as you can see, we had more inventoriable cost of goods sold deductions that we were able to allocate. And so the gross profit was $550, the C Corp tax rate was $115,500, and then that compared to $96,600 is not as significant as we had in our dispensary before, paying a much higher effective tax rate. So people often come to me and they say, well, what's my tax rate? You can't say that your effective tax rate is any one percentage, because there's a lot of different factors: how fast you move your inventory, what inventoriable costs you have in your particular business. But your takeaway from here is to know that a grower and a processor will pay more taxes than a non-cannabis business, and a dispensary, any kind of retail, will pay even more taxes. All right, GAAP. The tax court came back for, actually I should say that right now we're going to talk a little bit about growers and processors and their tax strategies, and thereafter we're going to talk about retail. The governing tax code for a grower and a processor, as I indicated before, is the manufacturing tax code. And that tax code stipulates that if you issue GAAP financials, generally accepted accounting principles, then there are additional costs that can be allocated to cost of goods sold, the only thing you have. So what is GAAP? GAAP is a nationally standardized method of accounting. It's governed by the Financial Accounting Standard Board, and it involves commonly accepted ways of recording and reporting for both the company and their accountants, and the goal of which is to improve clarity, consistency, comparability, and communication of the financial statements. And most countries have a set of, similar to GAAP. Nationally, typically it's something called IFRS, International Financial Reporting Standards. We have generally accepted accounting principles. So if you are a grower or a processor and you adhere to GAAP accounting, there are additional deductions that can be allocated to your cost of goods sold, remembering that's all you have to deduct. And they include the following: officer compensation, that's production related. So if you're an officer and you're growing or processing or even indirectly supervising those activities, and now with technology, we can do it from far away with our cameras. We have clients, they speak into their facility and tell the head grower or tell, the employees what to do, and, flip it over or add this or, something with the light. So you can literally supervise from afar. But then if you're doing the GAAP accounting, your pro rata salaries, payroll taxes, payroll processing fees, and in New Jersey, we have workers' comp, that can be allocated to cost of goods sold, making it deductible. Also, employee benefits. If any of you ultimate goal is an exit plan, you might be cognizant of the fact that key employee incentivization is very important. And one way of facilitating that is through employee benefits, health insurance, retirement, profit sharing. So when we do GAAP accounting, those benefits on the production laborers or officers become deductible because we can allocate it to cost of goods sold. A big one is depreciation. So your build out construction, your HVAC, your lights, your processing equipment can all be depreciated. The only difference is that we're using a GAAP method of depreciation, not an accelerated tax method of depreciation. But so what? It's still deductible. Takes maybe a longer time, but in effect, that potential is beneficial because we're deducting it in a future year when you have more income and you can use those deductions. But that is very strategic here because that will save your business probably a lot of money when you adhere to GAAP, just for that item alone. Also, insurance, not just insuring your crop, your cannabis, but the production part of your facility. Scrap, spoilage. We don't, plan for, things to go awry, but we've had many times where, crop was destroyed, infestation, using a new fertilizer that, somehow destroyed the crop. And when we do this type of accounting, we can write off those deductions. Also, as a grower or processor, you will be given part of your, after you harvest and cure and go through all the phases in your grow and you have your final products in your processor, you will have to give a sample to the testing facility. We can also account for that when we do GAAP. Certain taxes, like real estate taxes and taxes attributed to inventory. Give an example, in the state of Alaska, the growers are subject to $50 an ounce, $800 a pound of taxes. And because it's predicated upon weight, that's inventory, we can allocate that to cost of goods sold. And lastly, production-related administrative costs. Do I not have that on here? Yes, I do. Okay. And so what do I mean by that? Okay, if you hire, let's say, a consultant, administrative in nature, but if it's related to like a grow consultant or formulation consultant, we can allocate that to cost of goods sold. Maybe certain legal expenses as it relates to license acquisition, Part of our accounting costs when it relates to inventory accounting, absorption accounting, we'll allocate that. Also, we do CFO advisory, and when it relates to production capacity, we'll allocate that to cost of goods sold. Your tagging in the metric system, that is part of a track and trace system, so it's tracing inventory, we'll allocate that to cost of goods sold. Your POS or C2Sell compliance, if it's metric or other, that is designed half to facilitate relating to sales and half relating to inventory. So we'll allocate about 50% to that to cost of goods sold. So as you can see in the aggregate, this is a significant amount of deductions that would otherwise not be allowed if we weren't doing this type of accounting. So one of the fundamental parts of how GAAP is accrual-based accounting. So it recognizes revenue when they're earned and recognizes expenses when they're incurred, regardless when cash is exchanged. So to give you an example, let's say you have a grow and it sells $12,000 worth of flour to a dispensary, okay? And it says to the dispensary, you can pay $6,000 now and $6,000 in 30 days. Well, according to an accrual method of accounting, the grow will recognize $12,000 of revenue at the time of the transaction, and the dispensary will incur an expense of $12,000 at the time of the transaction, compared to a cash basis of accounting where the grow would recognize only $6,000 of revenue and the dispensary would only incur an expense of $6,000. So it is advantageous in that it's something called the matching principle. We're timing the related expenses so we can see the complete impact of the business transaction in that accounting period. Another key component and requirement is something called absorption accounting. To simplify it, I would say it's the process of allocating inventoriable costs that first are capitalized in inventory, and then we back it out to ending inventory via cost of goods sold on your profit and loss. But we have to allocate all production costs to either inventory or to your ending inventory and cost of goods sold. We have to account for work in process, which in a grow, for instance, is quite voluminous. Every time you plant, you're partially produced. So for instance, if you have a 100-day cycle, and as of December 31st, you're 25 days planted, you're 25% completed. So we have to account for all of your work in process and kind of do a weighted average to compute what is in ending inventory. It's a laborious technical process, but is a requirement for GAAP accounting, which saves you a lot of money. So what are inventoriable product costs? We've defined them, cost to purchase or manufacture products that will be sold. But what are the different types? We have direct materials. Those are the materials and supplies that are directly identified with the end product that you're selling. We have direct labor. That's the wages for the employees who convert those direct materials into the finished product. And then we have manufacturing overhead. Those are what we call indirect costs. And then we allocate that as well to the manufactured products. What are examples of this? So for labor, it's wages, payroll taxes. It could be payroll processing fees, workers' comp. For direct material costs for a grow, it can be soil, clones, seeds, fertilizers, hydroponics, etc. For a processor, it could be your cannabis. It could be, your baking supplies like milk, sugar, chocolate, etc. Solvents, emulsifier, etc. Indirect costs are rent, utilities, repairs, maintenance, tools, insurance. Those are indirect costs. All of them can be allocable to cost of goods sold. The only thing you have. What are non-inventoriable, aka non-deductible costs? Now, this is for any cannabis business, regardless of you're a grower, processor, or a dispensary. They are marketing, advertising, selling, distribution, interest, Income taxes attributed to income. We said that for a grower or processor, when they adhere to GAAP accounting, they can deduct real estate taxes and taxes attributed to inventory. General and administrative costs not related to manufacturing or inventory. We talked about examples just a moment ago for a grower or processor that when they issue GAAP financials, that there are some administrative costs that if they're related to production or inventory that can be allocable to cost of goods sold. And officer salary is not related to manufacturing or inventory. And we saw that when we do GAAP accounting for a grower or processor, if the officer is either growing, processing, or supervising those activities, we could allocate that to cost of goods sold. Now let's move on to retail tax strategies. Again, more challenging, but nevertheless, there are some things that we can do. I'll also preface it to say that even though GAAP accounting doesn't afford those additional deductions to retail as they do a grower or processor, we still do GAAP accounting, and I'll tell you why. If you're in a tax audit and we have a clean set of books, thoroughly documented accounting work papers which substantiate our positions and show our formulaic calculations and have the corroborating documentation as to how we allocated things for cost of goods sold. And then we use this national standardized method of accounting, generally accepted accounting principles. We're going to be afforded more credibility in this tax audit. And when we're afforded more credibility, we're going to be more persuasive in our tax in our arguments, especially in those areas of gray, that are gray with respect to tax law. And our goal of which is we want what we call a no change audit. We don't want anything to be changed. So it's kind of like ammunition. The more that you do, the more that you show at a higher level, the more respect you're going to gain, and the better you will succeed, and you will succeed better in the tax audit. But let's go on to 3 specific strategies that we have. Now, the retail tax code centers around acquisition costs and freight, okay? We include in the definition, or I should say interpret, okay, I have a little bit legal background, so I'm always thinking, how will I argue this? Whether not likely tax court, that's not likely, but much more likely the administrative arena of a tax audit. How will I argue this? So we include in the definition of acquisition costs, those costs we deem necessary to preserve, protect, and insulate our acquisition costs. I coined the phrase, if you hear it, it's from me, acquisition preservation costs. So let's give a couple examples. How about your security system? I think we all can agree that our security system is preserving, protecting, and insulating our cannabis, our acquisition. So the monitoring system will allocate the cost of goods sold. Cameras, let's say or equipment under $1,000 that we're not capitalizing and depreciating as a fixed asset, we'll allocate that to cost of goods sold. The labor to install it, or just labor to protect your store, not the guy carting people at the front of the door, because obviously that's to facilitate a sale, but if there's someone hired to protect your store, to secure your cannabis products, all of that labor, we will also allocate the cost of goods sold. Also, your inventory room. Your inventory room is designed to intake your acquisition, your cannabis, you count it, you secure it, you might have temperature controls, you're protecting it, right? So predicated upon your square footage of your inventory room, we will actually allocate rent and utilities to cost of goods sold. So let's give an example. Let's say you have a 2,500 square foot store and you have 250 square feet in your inventory room. That's 10%. 10% of your rent, 10% of your utilities will allocate to cost of goods sold. Now remember, everything that we do, and you should as well, is thoroughly documented in our work papers. Thoroughly documented, formulaic calculations, backup documentation, etc., designed to protect our clients. You have to do it designed to protect yourself. We actually had a client who had a store where the ground level was his store and the whole basement, which was commensurate in size, was his inventory room, and we wrote off 50% of his rent and utilities by allocating it to cost of goods sold. So some cases it might be small, some cases it might be larger. So if you're in your construction phase right now, you might want to make a larger inventory room. All right, labor. I don't know if you all know, but your bud tenders, because they're selling the cannabis, their wages and payroll taxes and everything associated is not deductible. You cannot deduct your bud tenders. However, what if that bud tender goes into the inventory room to receive a shipment, to count the inventory? Then they're performing an inventoriable task. Ideally, we would like them to punch out of the inventory department and punch out of the bud tender department and punch into the inventory department. If that is not feasible, then you should have some detailed contemporaneous records showing when that employee is transferring in and out of the room. Some people have codes to get into the room, and they can see like employee codes and they can track time. Whatever it is, you want to have a contemporaneous system, meaning as you go along to verify that that what we're asserting in terms of their functions is in fact genuine. So when they're going in pro rata, we will allocate to cost of goods sold their wages, payroll taxes, payroll processing fees, and workers' comp to cost of goods sold. Now, similarly, how about when one of those employees call up to reorder products, cannabis or non-cannabis, for resale? That I can clearly argue is an acquisition labor cost. So that too, we will allocate pro rata to cost of goods sold, making it deductible. All right. Lastly, cannabis and non-cannabis sales and expenses. Now, inevitably, most of you in a store or a dispensary or et cetera will sell, or delivery will sell non-cannabis items, Farm Bill compliance CBD, merchandise like hats and T-shirts, glassware, bongs, vapes, cones, paper. Your POS software will track that, and predicated upon the reports, we will deduct some non-cannabis, non-inventoriable, non-cost of goods sold, general and administrative expenses. So let me give you an example, and then I'll explain the functionality. Let's say you have $975,000 of the accounting period of cannabis sales and $25,000 of non-cannabis sales. 2.5% of your sales are derived from non-cannabis sources. So 2.5% of the residual rent, utilities, wages, payroll taxes, payroll processing fees, and workers' comp that we didn't already allocate to cost of goods sold, we will deduct below the line. 2.5% of professional fees, office supplies, computer supplies, internet, janitorial, bank fees, and other similar administrative costs, we will deduct below the line. By the way, never advertising, distribution, interest, or depreciation. For instance, your advertising and marketing, they can come all the way across town to buy your bongs. They came there to buy your weed. That's incidental. But all those other costs, we will deduct. We will thoroughly document this along with your sales reports in our work papers, as should you. We have a special accounting in our QuickBooks software with a separate chart of account numbers, and we show the allocations for that. So there's a really good audit trail. We will also itemize it on the tax returns. We'll say non-cannabis paraphernalia, office supplies, non-cannabis paraphernalia, wages, etc. And on our disclosure statement that we include with the tax return, we have additional legal verbiage to substantiate this. Now, I will say, in all the years we're doing this, I have never had it challenged in my firm. And I attribute that to the fact that, well, one, the way we prepare returns, but also we're being assertive. We're not being recklessly aggressive. Okay, semantically, it's a big difference. You want to be assertive because 280E, let's face it, is very, punitive and limiting, but you want to have a sound basis that you can argue in a tax audit. You have to have a sound basis and a reasonable basis, and it has to be documented very thoroughly. Okay, and that will help you, and that will go a long way. Okay, all right, so that's for retail. Now, entity structure. So for those of you, some of you might have already formed entities, but there are, and some of you may have not, but we'll talk about the best entity structure, and there are ways to revise that even if you have already selected it and decide that you want to change it after hearing this. Now, a sole proprietor or partnership or a single member LLC or multi-member LLC, and also an S corporation shareholder, what they have in common is for all of those entities, the income flows through to your tax return and you are personally liable, right? And there's a phrase that I coined called phantom income, meaning those deductions pursuant to 280E that you can't take flow through to your tax return and you pay taxes on it. It's not really income, deductions, but because it's disallowed, you're paying taxes. But the problem lies in the fact that if something should happen, you are precluded from discharging your debt in a federal bankruptcy court. Why? Federally illegal. And you will be stuck with this debt for at least 10 years because the statute of limitations on collections is 10 years from the assessment. In contrast, a C corporation gets taxed at the entity level, and you're not responsible for the taxes. The entity is. So that's advantageous. Now, at which point they deschedule cannabis and 280E is no longer applicable, maybe we'll strategize differently and maybe we'll elect S corporation status. Now, for those of you who formed an LLC, the default way of filing is a single member is a Schedule C and a multi-member is a partnership. We can elect to be treated as a C Corp. It does not affect your organizational structure. It's just the way you file your tax return on your, for your entity. And we can retroactively, if you have some reasonable clause, even get it accepted to prior years if you have not already filed, or the beginning of the year. If you have selected an S corporation, you have to revoke that S corporation to become a C corporation. But we always, we always advocate to be treated as a C corporation. Well, I learned how to go backwards. Okay. All right. I touched on this a little as we've been going along, but one of the most critical components is heavily catering to documentation, everything you do. Statistically, you are more likely to get audited in cannabis. Why? One, it's federally illegal, again. Two, due to banking problems that we all are cognizant of, and so is the IRS. It's a heavily cash-based industry transactionally. And so you're more likely, the probability is greater that you will get audited. It doesn't mean you're going to get audited, but statistically more likely. So you want to make sure that everything you do is thoroughly documented. You have to keep meticulous records documenting time. We talked about even in the dispensary, punching in, punching out, officers that are, doing different roles, and let's say a grower and a processor, they want to document what they're doing, whether it's administrative, whether it's supervising production, etc. And this would help you tremendously in a statistically more likely audit. It is crucial. Now let's talk about what you shouldn't do. People are always scouring the internet. Hey, 280E sucks. How can I save money? What do I do? And you'll find an array of information, and a lot of which is not the best advice. There is a tax code called 482. Actually, I think a lot of accountants are not even so familiar with this, but that allows the IRS to make allocations to reflect income attributed to the businesses and prevent tax evasions. And it can be for income, it could be for deductions, it could be for credit. When there is two or more organizations with the same ownership or control. And when I say control, I mean if you own one business and control it, and then you have another business and put it in your spouse's name, but it's under your control and supervision and guidance, that is a prerequisite. That is in sync with Internal Revenue Code 482. It doesn't matter that you don't own it, you're controlling it. And then the IRS can make adjustments from one entity to the other entity to more clearly reflect income. So be wary of that. If you're trying to use other entities to, write off expenses, it's not going to work. I understand it's very difficult to get bank accounts, and we often lay out things personally or use personal credit cards or other businesses' bank accounts, but make sure that they're always set up as loans from one entity to the other so you don't get in trouble. And also management companies. Over the years, I always hear about management companies. December 20th, 2018, there was a landmark case, Alternative Healthcare Advocate First Commissioner. Many of these landmark court cases are always out of California, and this was a California medical dispensary, and they had a management company called Wellness Management Group, Inc., and they provided services for like HR, hiring employees, like paying their wages, advertising, rent, etc., and they received compensation. Now, note that when the dispensary or any other cannabis business pays a management company for the services, it doesn't change the character of the expenses because they're paying it through a management company. If it's for advertising, and advertising is not deductible for a cannabis entity, it doesn't matter that you're going through a management company to pay it. It's not deductible. So in this particular case, the tax court held that they were using the same pool of funds, and consequently, the management company was trafficking within the definition of 280E, and so they subjected them to 280E. So moral of the story is management companies don't work. They do not work. And you are new in business, you want to set yourself up for success. And so this is one area to avoid. Now let's look at Form 8300. That's a cash report of cash payments over $10,000. And for this purposes, cash includes coins and currency of the United States and foreign currency, cryptocurrency, money orders, traveler checks, and the like. And it's for a designated reporting transaction. You have to use, report on this form. And also if you know that someone's trying to avoid, reporting of the transaction on the form. So the amount of cash has to be more than $10,000. And you receive it in a trade of business. If Aunt Millie lends you $11,000, that's not being received during the ordinary course of business. The same agent or buyer provides the cash, and you receive it in a single transaction or related transaction. So remember that example I gave before where the grower sells $12,000 worth of flower to the dispensary and they pay $6,000 at one time and $6,000 later. That's still a reportable transaction for Form 8300 because the whole sales transaction was $12,000. And also if there's previously unreported payments that cause it to be received within a 12-month period as well. So in order to comply with this, the business has to give like their EIN number, their address, their name, and if they send an agent or an employee, you have to obtain all of their information as well for this form. And you have to file it within 15 days after the transaction occurred. And typically we do it online, electronically with the BSA website. And all of this is governed by FinCEN, which is Financial Crimes Enforcement Network. And if any of you have ever filed an FBAR, that's also part of FinCEN. That's when people have foreign bank accounts or financial institutions and they have more than $10,000 in that account. So the information contained in here are referenced, like all these, the FBAR, the 8300 is collectively, gathered by FinCEN to expose criminal activities like anti-money laundering or tax evasion or drug dealing or terrorist financing and and other criminal activities. So today we learned a lot. Hopefully you gained a lot of knowledge. We learned GAAP accounting that is persuasive for all verticals, and it enables growers and processors to take more deductions for cost of goods sold, which is the only thing you have. We learned about 280E, and we also learned that breaking news that New Jersey, effective next year, we can add back our 280E expenses on a state return, and that will save, cannabis businesses a lot of money. We learned on retail the three strategies for acquisition for preservation costs, inventory and acquisition labor, and non-cannabis expenses. And then the 280E analysis that you have to document everything very, very thoroughly, because statistically you're more likely to be in an audit. Hope you've enjoyed this session. I have my contact information there if you want to screenshot it. If anyone has questions, they can shoot me an email. If you need assistance, we're here to help you, and wishing you the best of luck in your future endeavors.
Wow, Sandy, that was a lot. That was awesome. And we got a lot of positive comments too. This presentation's great, useful information. Thank you so much, Sandy.
Oh, nice.
So a lot of good stuff there. A couple questions. You mentioned this earlier about a bud tender, and then that person goes to the inventory room. They have different roles when they're doing that. One of the questions was, this one individual has plans to hire an inventory specialist separate from a bud tender. Is that wise?
Well, that's a personal choice. But again, if their role is limited to activities of inventory, then I would make the argument that it's allocable to cost of goods sold and therefore deductible.
Okay.
And one thing I think I failed to mention to add on to it, if they're packaging not to facilitate a sale, but to ease the inventory counting, I would include those activities as well as being allocable to cost of goods sold as inventory department.
Okay. Good information there. Aside from 280E, is 280E the only tax code that is different for cannabis businesses? Or most other?
Yeah, at the federal level, yes. At the state or municipal level, there could be additional taxes that are levied, which would be, again, specific to that locality or state.
Okay. And then another big one, which was, and I know you covered this, but you covered a lot. What tax strategies should a cannabis business consider to optimize their tax position? So I guess it goes over like S Corp, LLC, and some other stuff, but just generally speaking.
So is that relating to an entity structure or just a tax strategy in general? And do they specify what vertical?
Did not specify, just
Okay.
What strategies, what tax strategies should a business?
Well, again, yeah, I don't know if perhaps that person may have come in late, but for a grower or processor to utilize GAAP accounting, for any business to thoroughly document accounting work papers. For instance, we use GAAP work papers, 280E work papers, and absorption work papers. For retail, we reviewed those three different strategies. But if that person wants, I mean, we've covered in great detail, but if that person wants to contact me directly, I'd be happy to review it for them and maybe tailor it a little more for their specific situation.
Okay, very cool. That was it for questions. There was mostly just really positive comments of how useful this is and things like that. So
wonderful.
But I want to, Sandy, this is awesome. And Sandy and I have known each other for a number of years. We've been on panels together. For those of you who are asking, can I receive a copy of the PDF or what have you? This is recorded, so this will be posted on YouTube shortly. Once Jenna does her magic to get it ready. And then so everybody will have access to the entire presentation through this recording.
Okay.
Sandy, again, I just want to thank you and Cannabis CPA so much for your support for the NJCBA, for all your hard work that's out there, and it's truly appreciated. So thank you very much for this.
Thank you so much for having me. It's been a pleasure, and I'll see you soon.
We're going to see you soon. I do want to thank our sponsors again, Prague Energy, who is our preferred energy partner, Financial Resources Federal Credit Union, Curaleaf, Burton Trent Public Affairs, HBK, Township Green, Proteus 420, Saks LLP, Dutchie, our good friends at Puffin and Canna Remedies, and DM Labs. So again, thank you very much. We do have another event coming up. We're gonna have Kate Giuliano from Ascend Wellness, and she'll be there to talk about at our next event on May 24th, discussing supply chain issues. So again, everybody, thank you for tuning in to our Lunch and Learn. We're going to be doing more and more of these as we progress. And again, special thank you to Sandy Where's Sandy? Where'd she go?
I'm still here.
There he is. There she is. So Sandy, again, I really truly appreciate our friendship and all that you've done, and really appreciate you participating here with Lunch and Learn.
Thank you very much, Scott.
All
Pleasure.
right, guys. Thanks,
Bye-bye,
everybody.
everyone.